following paid commercial program is brought to you by TD Wealth.
Welcome to Money Talk. I'm Kim Parley. Thanks so much for joining us. If you've been to the gas pumps lately, you can probably guess that oil prices have been going up this summer. As a matter of fact, crude prices have rallied more than 20% since June. So what's behind the recent rise in oil prices, and could we be sitting on an oil super cycle? Joining me is Daniel Ghali, Senior Commodity Strategist at TD Securities. It's great to have you here.
Yeah, thank you very much for having me.
What's going on?
Well, listen, I think if you're looking at the rally in crude oil prices over the last month, it's been backed by the supply side of the equation. In fact, our gauge of energy supply risk is now at its highest level since the war in Ukraine. But when you circle back and you think to the market context last year, this rally is very different from that. This is an engineered tightening by Saudi Arabia, by Russia. And in fact, it's coming at a time where demand is still quite hot. And that differs from what we saw last year.
Let's talk a bit about the engineered supply decrease. Tell me kind of who's doing it, why, and how long do you expect that to last?
Well, that's the big question, actually, in oil markets right now. So who's doing it? It's Saudi Arabia and Russia primarily, in addition to OPEC's well-telegraphed cuts, right? So Saudi Arabia came in with a massive 1 million barrel a day voluntary production cut. They've also managed to kind of rein Russia in. If you recall, Russia's production was actually rising, but they're part of the OPEC deal. They should have been cutting production. And in fact, it was more a question of their exports rather than production. But ultimately, they managed to bring Russia in by curtailing their exports. In combination with Saudi's cuts, that's a pretty significant tightening.
We can bring up the price chart. We can see for a WTI and just take a look to see what's happening. But that's what's happening with supply. Let's shift to the other side here on demand. And it's interesting for you to say that, demand is still there. We keep hearing about a softening of the economy. We keep hearing that things are slowing down. This doesn't reflect that.
Yeah, you can't look at the energy demand for any sign of recession coming.
Why is that?
Well, if you think about, we've went through a pretty extraordinary series of events since the pandemic, right? Yeah. This year, most of the energy demand growth that we're seeing is simply related to China's reopening. It's not, a super complex thesis out there. China's reopened. There's a lot of pent-up demand for travel. But even in the West, if you look at Western Europe and North America, prices aren't high enough for people to stop driving on their summer vacations, for instance. Really, if you get nitty-gritty, you can find some signs of economic weakness, right? Things like diesel demand have been at some point weakening. That's associated with kind of the freight recession that people have been talking about. But overall, oil demand is actually at a record high.
I wonder if is that a lagging, in terms of economic indicator? You're starting to see the basics like diesel and things slow down. The consumer, will they weaken? And that will reflect in oil, I guess, later on, if it happens.
I mean, potentially. But what we've been saying is that even if there is a recession, overall oil demand isn't all that sensitive to it. So oil demand growth is related to the magnitude of the economic growth, but there's only been 4 instances ever since we've used oil, in our economies where oil demand has actually declined on a year-on-year basis. So given the spare capacity concerns last year in particular, that was the big concern.
I want to come back to that in just a second, but just to go back to China for a moment, it was interesting you were saying China helping dictate what's happening, and I actually was listening to you speak with Greg Bonnell earlier today on Money Talk Live, and you were talking about how China is affecting the basket of commodities. It's quite interesting, where oil is getting a lift because people are hopping on planes and traveling everywhere, but we're not seeing the lift in other baskets of commodities.
Yeah, there's absolutely no evidence of a boom in demand coming from China's reopening outside of the energy complex. So if you think about raw materials, for instance, China's real estate sector accounts for 30% of all raw material demand when we're talking about industrial metals. So the weakness in the property sector that is pervasive, that continues to impact our economy, that's weighing on copper demand, on aluminum demand, zinc demand, et cetera.
Let's go back then to what you were saying about oil. You're not looking ahead to see a big fall in the oil prices, which leads me to the title of your note where you talk about super cycle on or super cycle off. So which is it?
Well, it's funny because a super cycle shouldn't be on or off, right? It should be a decade-long period where spare capacity is being eroded, where we don't have enough supply to satisfy the demand. demand side of the equation. But it's funny because we've come to a situation where it feels like it's either on or off. And that really is kind of the antithesis of a super cycle.
Right.
What we're seeing on the negative side of is there an oil super cycle coming is the actual increase in investment of supply. That's primarily coming from the Middle East, South America, even in some instances in the West. But overwhelmingly, the structural undersupply story is becoming a Western story. So the U.S. shale patch, Canadian oil sands, and so on and so forth.
What about the structural demand side, I guess, in terms of where you see that going?
Well, for the structural demand side of the equation, of course, electric vehicle penetration has actually been far faster than most people have anticipated. But even then, it just takes such a long time for a new EV sale to destroy demand because those internal combustion engines are still on the road. It's going to take a long time, and that suggests that demand is only going to slow at a very slow pace, whereas the supply is really what we're concerned about.
All right, so take me then through 12 months from now. We're sitting here. Where do you expect to see oil prices?
You know, actually probably not all that different than where they are today. So we're forecasting Brent prices to finish the year at around $90 a barrel and to finish next year around $94 a barrel. So we're really talking about a range-bound oil market from here.
Daniel, always great to have you here. Thanks so much.
Thank you very much.
Daniel Ghali, Senior Commodities Strategist at TD Securities. Stay with us. When we come back, we're going to dig into the upcoming tax changes that could impact donors of stocks and public traded securities to charities. You might want to listen to see what it could mean for you. Don't go anywhere. You're watching Money Talk.